first thing I'm going to say is that Shark Tank is, well, it's hyped up for television. That's not really the way it is. There are some similarities, and as we go through it, I'll talk a little bit about that. The other thing I'm going to say is that raising venture capital, what I'm going to talk about, this is a high level. I do other series where I talk about, for example, how to create a pitch deck, actually connecting with investors and things like that. I definitely want your, questions. But what I'm going to say is that these are my experiences, good, bad, and ugly. And I'm happy to share those with you. Different people have different experiences, some, really great, some really bad, and everything in between. So just like every entrepreneur is different, every business is different, and every one of you is different, everybody's experiences are different. But there are some commonalities, and there are some lessons and some things that I've learned along the way. I'm going to talk about two main lessons. So, George, you want to go to so before he turns the slide, what I will tell you is the answer to this question, what's it like to raise venture capital? It's hard. It's extremely hard. So, George, if you can go to the next slide, what you're going to see is some of the statistics. So when I say it's hard, I'm not kidding, right? Less than 6.5% of high growth companies receive venture capital. Less than 6.5%. And that's actually the ones that go looking for venture capital. So it is very, very difficult. And not every business is suited for venture capital. And I'll talk about that in a second. But what I will also say, I see a lot of people of color, a lot of women. I'm Hispanic, I'm a woman. And if you look at the next statistic, you'll see that that's not very promising either. That only 2.2% of the 6.5% went to women CEOs and founders. When you add to that women of color or people of color, the numbers they just go down from there, which is really unfortunate because, there are a lot of studies that show, different perspectives and viewpoints really make a difference in success. So that's unfortunate. It is changing. There's awareness of this, but it's hard. And I've had experiences where I had great investors who, were very supportive. And then I've had investors that were middle of the road. And I've had investors that were basically the investors from hell. And all, everything in between there. So in 2019, you can see that there were over $137 billion deployed, but it wasn't to a lot of different companies. And interestingly, you can see that there was more in 2020 during the pandemic. I think there were a lot of companies that found themselves, especially if they were early stage and they found themselves in a difficult position or needing cash reserves, because when you're an early stage company, especially venture-backed, you're often, heavily investing. You're usually operating at a loss because you're investing in the future and in the company. So all of a sudden, everything getting shut down, depending on the industry you're in, could have, for a lot, for regular businesses, it was devastating. For others that are early stage, I think it was probably worse. And I think there were lots of investors that kind of came along and to take advantage of this. And I never did, yes, loans can be a good way. I've never done crowdsourcing. So you guys are, a lot of you, I see a lot of younger faces. So I think you guys probably are more versed in the crowdsourcing. I have not personally done that. I haven't had that experience. So I've been more on the traditional side. So then when you go up from friends and family, the next level would be most likely angel investors, or which are a lot of times they're entrepreneurs. There may be an angel fund that they invest small amounts, 10,000, 50,000, 100,000, not big amounts, generally up to 2, 3, 400,000, 500 in that range. Kind of the next level you get to then is in venture capital. And that's venture capital is typically, well, actually, before we get to venture capital, there's something in between called a family office, which is where you have someone who's got a family that has lots of money, and often they will create a fund or an LLC or a format in which to invest, and they invest in companies, but they're not institutional money. So institutional venture capital tends to be what they call institutional money. And when you look at the stock market, you have mutual funds and different investors who invest in different types of stocks. Well, they usually reserve, like for example, Goldman Sachs, they reserve funds that they put in more risky ventures, because early stage venture capital is for early stage companies, and it's considered risky. It is risky. So they count on what they call unicorns or breakout companies, 1 or 2 out of 10. They expect those to carry for all of the others. And of the other 8 or 9 companies that don't make it big, aren't the next Facebook, aren't the next Airbnb. Of those 8 or 9, 40% more or less, they expect to be a complete loss, 100%. They figure they're going to put their money in and they're going to lose it. It's going to be gone. And then the rest of them, they expect are going to kind of chug along at, either break even or maybe a 30 or 40% growth rate. So just so you guys, I don't know if you know this, but in any world besides the investment world, a 30% growth rate would be outstanding. A company like Coca-Cola they would love to have a 30% growth rate. But in a venture capital firm, they want to see 100% growth rate. So 30% is nothing. So they count on those big ones. I'm not sure. I don't think that it's a great model. I will tell you that there are some VCs or venture capitalists that are kind of getting away from that. So those are the VCs, and they range in size. Anything from micro VCs, which might have 15 or 20 million under management, all the way up to 100 million, or the large VC venture capital funds like the Kleiner Perkins that invest in companies have invested in like Facebook and things like that. First of all, if you're thinking about raising venture capital, we talked about it's hard. So if you're thinking about it, the type of business you have matters. So service companies usually are not good for venture capital. It's usually not consultation type businesses. Typically, investors will often have kind of a flavor of the time, which that might be, for example, more recently was the artificial intelligence. That was kind of the buzzword. There was a time period when I was raising money. When I was raising it, they were and they still are very focused on technology, software technology, software as a service. as far as why not service, so first of all, they're looking for highly scalable businesses. Remember, they expect to see about 100% return or more. So they're looking for something that's going to really scale quickly. And service type businesses, that doesn't mean to say, never say never. I would never say that no, if you have a service business, you're not going to get venture capital, but they tend to be kind of lemmings, and so they go in packs. So if they're focused on artificial intelligence, there was a time they were focused on the Internet of Things, and whatever they're focused on. When Facebook came out during that time period after Facebook, it was all about social media, and so you saw all of these social media startups. Is this sounding familiar? What I will tell you is that they change, and you might come up with the next big thing. I mean, who knew that Airbnb, who would have thought, what, hotels, stays, and they came up with something new. So a new category, that happens too. So I would say, just know that the odds are stacked against you. And George, if you want to go to the next slide, we can talk a little bit about what it means, what venture capital, the previous slide. Okay, so basically, one of the very first lessons that I learned is it's a wild ride. There are high highs and low lows, and you better fasten your seatbelt. You also need to keep in mind that if you're going to raise money, if you're going to pursue venture capital, and there are a lot of other ways, you guys mentioned them, loans, friends and family. There are other ways to raise capital, and especially if you're pre-revenue, or you've got some revenue, you may be better off funding your business through sales and through bootstrapping, because raising money is a one-way trip. If you're going to do it, it's going to take most of your time. So if you're doing all of these things for investors, then what you're not doing is running your business. And the smaller you are, the earlier stage you are, the harder that can be. And it is hard. There's not enough time to go around, right? And that's whether you're raising money or not. So one of the things that I often share with people, I will tell you that if you decide to pursue venture capital, it's a wild ride. And so one of my the stories I often share is when we started raising venture capital, we decided this was our sixth business, my sixth business, and we had proprietary patent pending software. We knew that this was something different, something unique, which in part was one of the ways we were protecting our IP, Lauren. But we knew that it was going to be capital intensive. We were going to need a lot of money in order to invest in developers and getting this out there on the market. We knew that we needed a lot of money. And so we made the decision to raise venture capital to pursue investment. We were told by people who knew, people in the business community and things like that, that it would take 6 to 9 months. And we thought we were being really smart, and we planned for 15 months on the outside, so 12 to 15 months. And so by the time we got there, now we were already 3 months past our worst case scenario. By the time we got there, my husband and I had not been paid in over 6 months. We were putting money into the business. We were, had pulled on all of our credit cards and loans and everything we possibly could. Employees were holding paychecks. I mean, we were really on fumes because, again, you're focusing more on raising the capital. When we finally got that term sheet, It was, so when we got our first term sheet, we got it in October, and we were told we were going to close before Thanksgiving. Okay. And we're on fumes at this point. And so put it this way, by the time the money we closed, we had $87 in the bank account. Okay. We were really struggling. So when I talk about highs, the low was the stress of getting there. And what we knew was if we had to close before, here we were, it had pushed into December, it was going. And we knew that if we didn't close before the end of the year, the VCs, everybody was going to go on vacation. If it didn't happen before the end of the year, we were going to close the business. We couldn't make it anymore. And so, we're doing everything we can. People are holding paychecks. We're just, doing hanging on by a thread. And on the 22nd of December, we still hadn't closed. And I'm pushing, I'm calling up the investor. I'm saying, come on. And of course, you don't want to be too desperate because you don't want to say, hey, look, if you don't put that money in the next 2 days before Christmas, we're done for. You don't want to say that. So you're saying I did everything I could. And finally, on the 22nd, I got to a point where I said, I can't do anything else. It's either going to happen or it's not going to happen. And I went to bed and I woke up on the 23rd of December, and everything, it went bam, 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 bam. And we closed on the 23rd of December. Now, when you close, the way they do it is everybody signs papers and it's all distributed. And we got on this big conference call. Lawyers, venture capitalists, us, we're on this call. And I've got the bank account because until the money's in the bank, you haven't closed. It's not a done deal. So here I am. The lawyers say, okay, does everybody release the signatures? Yep, we released the signatures. Great. All right. And I've got the bank and I'm refreshing. I said, money's not there. And the VC says, we've released the funds. It should be there. And I'm refreshing. It's not there. It's not there. Now I'm looking at this, $87, $87. It's not there. 87. And then all of a sudden, bam, 7 figures. It was the most awesome feeling in the entire world after everything that we had gone through. Now that was the 23rd of December. On the 24th, I spent Christmas Eve, I spent it in the hospital with the worst migraine of my life. And so remind me to tell you about monkeys and about learning to let go, because that was another lesson. First of all, let's talk about how much you need. You have to determine, how much. Typically, you should plan on 18 months to ideally 18 months to 24-month runway, which is the amount of time. How much capital do you need to run the business and invest in the business, which includes, investing in the product, investing in sales, how much money, think of it as the budget for the business. And you go through that, you work with whoever's doing your financials, you work with your accountants, you come up with those numbers. And by the time you're talking to investors, before you even talk to them, you better know how much you need, because that's going to impact who you're going after. If you're going after, angels, if you're trying to invest with VCs, get investment from VCs, because VCs don't put less than $1 million. So $1 million or more. And in our case, our first investment was 1.5 million. So the way that you go through and you do the math and you figure it out. And that's actually leads to the third point on here, that the rule of thumb is however much money you think you need, however much time you think it's going to take to do anything, whether it's raising venture capital or it's growing your business or whatever it is, rule of thumb. So multiply your worst case scenario by 3 and then add 10%, because it always takes longer than you think it's going to take and costs more than you think it's going to cost. Most of the time, especially the more sophisticated investors, they're investing in the team. So they understand that a great team can take a mediocre product and make it successful, and the reverse is not true. So one of the things with investment and with VCs, ultimately you are selling. And if you remember that, and there are a lot of things that kind of go into that, you've got to network. And I recommend to people, if they're thinking that they're going to raise venture capital, before you even get to the point where you might start getting out there, you need about a year of networking and getting to know people. You want to be out in your community, out in the business community. And by the way, if you want to build a business, you need to do that anyway. You got to know what's out there. You're going to need to network in the business community for talent, for employees, for investment, for business opportunities, all kinds of things. So if you're not comfortable with networking, get comfortable with networking. So I have pitched, several years ago, I pitched at Venture Atlanta. I've pitched at Venture Florida. So I've been up on a stage in front of, on TV and in front of, 1,000 investors. I've pitched in a small room, to kind of a conference table size of investors. I've pitched to a bigger room, a bigger audience of 50 or 60 to angels and stuff like that. And I've pitched one-on-one. And probably the most common is the one-on-one. That's the most that you're pitching one-on-one, because usually you have to do that before you can even get to pitching, say, to the larger VC group. You have to typically have a conversation with one of the VCs. So because most of the time, it is difficult, you do need to, you got to get used to hearing no, and you got to pitch a lot, and do it a lot. And you get better at it as you go. So for example, when I started pitching, if you looked at my first pitch deck, I go back and I look at my very first pitch deck and I go, ugh, no, and this was wrong and that was wrong. And as you go, you get better at it, you learn. And one of the most important things is actually to be able to get to a no quickly. A no is, yes is great, but you don't usually get to a yes that quickly. But a no quickly, because you don't want to waste your time, not your time and not their time. So a lot of these have, these submit here. I was on a panel a couple of years ago, and the moderator asked how there were 3 entrepreneurs and 3 investors, and they said, how many of you have gotten the deals that you closed? How many of you got deals through the website? Would it surprise you to know that the answer for both was 0? Absolutely 0. They got all of the investors, and yes, you got it. All of the investors, you got it, Al. All of the investors and all of the entrepreneurs got to the deals by somebody they knew that introduced them. That's how. And I can tell you from my own experience, that is exactly how I got to the deals. 100%. So one of the things I do want to tell you real quick about the confirmation bias is that most of the time, and when we talk about pitching, and if you want to have more questions and more discussions later, and if you want to stay on, I can talk a little after. Confirmation bias is where investors, and they're very guilty of this, they usually go in and they've already decided before anything else, 30 seconds in, they've already decided, and they look yes or no, and they're looking for evidence to support whatever their decision, their feeling was. I got to the point after doing this for many years, I got to the point that I could tell if an investor was going to invest inside of about 30 seconds of meeting them.